Today I'm reviewing my second SPY trade from August 7th, 2026. This trade is a useful example because it wasn't simply an entry followed by an exit. The setup developed. I increased my exposure as the technical picture strengthened, and then I reduced the position in stages as SPY moved into an important resistance area. Let's walk through exactly what I was seeing and how I managed the trade. Before looking at the actual trade management, I want to start with the context. On the left, I'm looking at the 15-minute chart. On the right is my 5-minute execution chart. Having both views helps me understand the larger structure while still managing the trade from the shorter time frame. On the 15-minute chart, SPY had previously sold off and established a higher low area. From there, price began recovering. What interested me was that this wasn't just one isolated green candle. There was a developing recovery structure. Price was working its way back toward resistance. At the same time, the 20 EMA was beginning to support the recovery. The 200 EMA remained considerably below price, so the broader structure wasn't fighting the long idea. But there was something very important above price: resistance. Support and resistance. I had several clearly defined price levels on the chart. The area around 770.59 was an important intermediate level. Above that, the area around 772 was another important resistance zone. And beyond that was the previous structural high. So before entering or increasing exposure, I already knew where price might encounter sellers. That's important because I don't want to look at the EMA by itself. The EMA tells me something about momentum and direction. Support and resistance tell me where that momentum could run into trouble. The 5-minute chart. Now look at the 5-minute chart. SPY had experienced a sharp morning decline. But rather than continuing lower, price reversed aggressively. Price recovered the 20 EMA and began moving back to the levels above it. That changed the character of the chart. Instead of looking like continued weakness, buyers were showing that they could regain control. The 20 EMA was also turning upward underneath price. That gave me a dynamic reference point for the long side. Why the long trade made sense, what I liked here was the combination of factors. I wasn't relying on one signal. I had improving structure. I had price recovering above the 20 EMA. I had the 200 EMA below price. And I had clearly defined support and resistance levels that told me where the trade had room to move and where I needed to become more careful. That was the framework behind the trade. The trade strengthens. Now we move forward in the trade. This screenshot is important because the technical picture had strengthened considerably. Why I increased the position? Look at what happened after the pullback. SPY produced a strong recovery candle and pushed aggressively back toward the previous high. Price was above the rising 20 EMA. More importantly, it had reclaimed the intermediate levels that had previously been potential resistance. This is where the trade became stronger from a technical perspective. I wasn't increasing exposure simply because SPY was going up. I wanted the chart to give me another reason. And here it did. Price had recovered from the pullback. The 20 EMA was underneath the move. The intermediate resistance areas had been reclaimed and momentum had returned. That gave me the technical justification to increase the position, the important resistance above, but I also had to recognize what was directly ahead. SPY was now challenging an important previous high area. This is where the concept of space becomes important. A strong setup doesn't mean I can ignore the next resistance level. As price moves closer to resistance, the amount of available space becomes smaller. So even though the trade was working, this was also an area where I needed to start thinking about trade management rather than simply continuing to add exposure. First partial exit. Now we can see the next stage of the trade. SPY had continued holding above the breakout area. Price was still above the 20 EMA. The bullish structure had not completely failed, but price was now trading near an important resistance zone. Why I reduced the position? This is where I reduced part of the position. Taking a partial exit doesn't necessarily mean I believe the entire trade is finished. That's an important distinction. The trade had already made progress, but it was now approaching an area where I knew sellers could appear. So rather than making an all-or-nothing decision, I reduced my exposure while keeping part of the position open. That allowed me to accomplish two things. I could protect some of what the trade had already given me while still participating if SPY continued higher. Why I didn't exit everything, the reason for keeping part of the trade open was also technical. SPY hadn't completely broken down. Price remained above the important intermediate support areas. The 20 EMA remained underneath price, and buyers were still attempting to push through the upper resistance zone. So I didn't necessarily have a technical reason to declare the entire trade finished. Instead, I managed the exposure. That's one of the benefits of partial exits. Trade management doesn't always have to be all in or all out. The position can change as the chart changes. Later partial exit. Now look at the final screenshot. SPY continued higher and was trading around the previous resistance area. This is where I reduced the position again. Why I took another partial exit at this stage? Price had already traveled a meaningful distance from the morning low. The trade had gone through several stages. Recovery, reclaim of the 20 EMA, breakthrough intermediate resistance, continuation, and now a test of the upper resistance area. That matters. The farther a trade progresses, the more I want to think about protecting the position rather than treating it like a brand new setup. SPY was still showing strength, but it was also operating in an area where I already knew resistance existed. So I reduced exposure again. What this trade shows about scaling, one of the main lessons from this trade, is that scaling doesn't only mean adding. Scaling works in both directions. I can increase exposure when the technical picture strengthens, and I can reduce exposure as price reaches areas where the risk-reward begins changing. That's exactly what happened here. Earlier in the trade, the chart gave me additional confirmation, so I increased the position. Later, price moved toward resistance, so I began reducing the position. Those are two different decisions based on two different stages of the same trade. Trade outcome, the screenshots clearly show that I increased exposure and subsequently reduced the position in stages as SPY moved higher. However, these screenshots alone don't provide enough information to calculate the complete overall financial result of the entire trade accurately. So I'm not going to manufacture a winning or losing classification from incomplete information. Overall result cannot be determined accurately from the screenshots provided. Trade quality, what I can evaluate is the technical decision making. The trade had several things working in its favor. The recovery from the morning weakness was strong. Price reclaimed the 20 EMA. The 20 EMA began supporting the move. SPY moved through important intermediate resistance levels. And when the trade reached the upper resistance area, exposure was reduced rather than assuming price had unlimited room to continue. From a process standpoint, there was a logical progression. Technical confirmation increased, exposure increased. Then price approached significant resistance, exposure decreased. That's the part of the trade I find most useful. What I did well, I think one of the better aspects of this trade was that the management changed with the chart. I didn't treat the position as static. When the technical picture strengthened, I was willing to increase exposure. When SPY moved into resistance, I was willing to reduce it. I also wasn't relying exclusively on the 20% EMA. The EMA was part of the decision, but support, resistance, structure, and available space were equally important. What I would continue to study, the area I would continue studying, is the relationship between scale-ins and available space. When I increase exposure, I want enough room between my addition and the next major resistance level to justify the additional risk. That's something I want to evaluate across many trades rather than judging from one example. The same applies to partial exits. Over a large sample of trades, I want to know whether reducing exposure around these resistance areas improves my overall trade management. That's where keeping detailed trading records becomes valuable. Key lesson, the main lesson from this trade is scaling is not simply about adding to a winning position. Good trade management means adjusting exposure as the technical picture and available space change. This trade provides a good example. The chart strengthened, so I increased exposure. Price later approached an important resistance area, so I reduced exposure in stages. The system gave me the framework. Price action told me how to manage the trade. And that's what I want to continue documenting in these trade reviews. Disclaimer: this video is for educational purposes only and is not financial advice.